All right, now, what is almost certainly the most popular legal entity in today's times for owning and operating real estate is a limited liability company. I'm going to spend most of my time, George, I know we're going to take a break here shortly, but I'm going to spend most of my time talking about the limited liability company because, for the reasons that will become obvious, it's by far and away the most popular entity in today's world, even though it has to pay a franchise tax, and hopefully that'll be explained. But the members of the limited liability company, the managers of the limited liability company, and the officers will have limited liability for any contractual liability if they sign the contract right and do a few other things that we're going to talk about, like pay the franchise taxes. Now, they have limited liability for the tort liability of the LLC. But that doesn't mean that their own conduct is exempt. You are always going to be responsible for your own individual conduct in terms of breaching some duty that you owe somebody. And by far and away, the smartest advice that I can give all of my clients is to make certain that you've got good liability insurance. I recently had a client referred to me by another lawyer, and the client had been in an automobile accident, and he had the minimum automobile liability insurance, and now he had mega $1 million of liabilities, and he didn't have liability insurance except for the basic coverage. And he had a huge net worth that he ran the risk of losing, and it's easy advice for lawyers. We're not in the business of selling liability insurance, so we can't be faulted for recommending it. I don't even typically recommend liability insurance agents or insurance companies, but I do think it's incredibly important, and in the 30 years that I've been practicing law, I can't tell you how often I've represented clients, including lawyers and title companies and other professionals, where the liability insurance is what saved them from losing everything they had. Now, you also can't commit fraud or intentional torts or violate the DTPA and escape personal liability. The DTPA, let me define that term, that's the Texas Deceptive Trade Practices Act. And we won't have time to talk about it, but frequently liability insurance doesn't cover breaches of the Deceptive Trade Practices Act, and they frequently don't cover fraud or intentional torts, and they almost never cover contractual breaches. So, but liability insurance should always be your first round of defense. The insurance carrier has a duty to defend you in a lawsuit if a lawsuit is brought where there is a claim that you were negligent. And lawyers have figured this out. They've realized that they want the liability insurance carrier on the other side because that gives them a deep pocket, and liability insurance carriers are going to have to step up and defend the lawsuit. It may give you a well-financed defense on the other side, but they have a great deal of experience in lawsuits, and they know what a lawsuit's worth, and they'll frequently, huge percentage of the time, if a party is represented by an insurance carrier, they're going to get it settled on terms that are reasonable under the circumstances. And the duty to defend the individual extends if there's any cause of action that sounds in negligence that's covered by the policy. So there may be claims of fraud, there may be claims of intentional torts or breach of the DTPA. You might realize the value of explaining to the opposing attorney why it would be in his client's interest to include a claim for negligent misrepresentation in addition to fraud, so that you could pick up the phone and call your insurance carrier. Limited liability company in Texas, at present, there's a $308.10 filing fee plus annual franchise taxes. Now, the good news is franchise taxes are based upon something that we've defined as a margin, and the margin starts with gross proceeds. And gross proceeds, the state legislature has exempted over the years as much as $1 million in gross proceeds. Started with $600,000. And this year, it's $1 million. So if you don't have gross proceeds of at least $1 million, you're not going to end up paying a franchise tax. And then once you start with the gross proceeds, then you get 3 forms of deduction. You have to choose only one per year. And if you have multiple entities, you're going to have to file combined returns, and you're going to have to choose the same method of deduction for all of the entities for which you're required to file a combined return. So if you've got more than, say, 50% of an interest in multiple entities, you're going to probably have to file a combined return and only choose one of the 3 deductions. The 3 deductions are either a straight 30%, so you're never going to pay more than 0.7% of your gross proceeds, or your cost of goods sold. Most of my clients who are in the real estate business, they're going to choose the cost of goods sold as the method of deduction in the year that they sell the property. If they're holding the property and they've got most of their deductions come from compensation to the management company, etc., then they're going to typically choose total compensation. But you only get to choose one of the 3, and it's going to apply to all the entities for which a combined return is filed.
So wait a minute, let me make sure I understand this. If I made, let's say I have one rental property.
Okay.
And I know we're talking about wholesalers, but if I have one rental property and I made $10,000
right
on that rental property.
Right.
I had management costs, let's say that ran me $2,000 for the year. But I really, I mean.
Well, first, let me interrupt you for just a second, because the first threshold question is, did you have gross proceeds of more than $600,000 or $1 million, whatever the threshold is, the minimum threshold is for that year. So if you got rental properties and you don't have $600,000 of gross proceeds, you'd have to have a lot of houses in a year to have $600,000.
Okay.
But the problem comes when you're selling property, because you could sell a lot of properties in the same year, and suddenly your gross proceeds will exceed the $600,000 or the $1 million. Now, we just came out of the state legislative session. Every government is under great pressure to raise revenues because we got a budget shortfall at the state level. So don't be surprised if the threshold that represents the minimum at which you start paying franchise tax gets lowered over in the coming years.
Okay.
And you're going to have to look and check with your CPA. One of the things I love about the state franchise tax is it's amazingly transparent in the sense that you can go right online and Google Texas state franchise tax. The comptroller of the currency, the state comptroller's website will come up. There are forms that you can fill in. It comes right off your IRS form for your LLC or your corporation. You go straight to the gross revenue proceeds box, and if that figure is less than the $600,000 or $1 million or whatever it is for that given year, you're not even going to have to pay a franchise tax.
Okay.
The tax return is due May 15th after the calendar year that you're finishing.
Gotcha.
So if you go online and you don't have the gross proceeds of the $600,000 or $1 million, you're going to not have to pay a tax.
You still have to file it.
You still have to file the return. Right. Now, one of the problems with the limited liability company for many, many years was that we didn't know how the IRS was going to treat it. We didn't know if it was going to treat it as a C corporation or as a partnership or whatever. And they came up with, originally in 1996, and then apparently they finalized rules around 2000 that we lovingly refer to as the check the box system. And literally you check a box as to whether you want it treated as a C corporation, or if you want it treated as a partnership, if it's got multiple members. If it's only a single member, one of the options that's available to the single member is to have the LLC completely disregarded as a taxable entity. So if you're an individual and you go out and form an LLC and you're the only member, the only owner, then one of the options that you can have is to have it simply disregarded as a taxable entity. What does that mean? That means you're not going to have to pay or file a separate tax return. It's as though you were running it as a sole proprietorship. You're going to carry your income and your expenses over to a Schedule C or a Schedule E for rental properties, and you don't have any other tax reporting obligations. Now, you can choose as a single member to have it treated as a C corporation. If you've got multiple members, you can elect to have it treated as a partnership or as an S corporation or as a C corporation. That's why it's called check the box. It says single member, check the box as disregarded, or as a C corporation, or multiple members, you can have it treated as a partnership, S corporation, or C corporation. Now, some banks, I don't think they should, but some banks think that you're going to have to apply for an employer identification number when you get a bank account for them, even though it's a single member LLC. My own opinion is that they ought to simply allow you to use your own Social Security number when getting that account. But some banks just have their own game plan. All right, I'm going to very quickly talk about, and then I think we'll take a break, how you should always, always, always sign your contract. And I'm not just going to tell you, I'm going to show you.
Let's do this. Let's take a break and then we'll do that.
Okay, great.